And the recent Australian federal budget announced several changes to employee share schemes, or ESS, making them significantly more accessible for businesses to implement. With the Australian unemployment rate at a low of 4%, ESS gives businesses a new strategy to attract and retain talent with competitive salaries. For more on this, I'm lucky enough to have Kudzai Mhishi from BlueRock here to tell us more about how this can help businesses. Welcome to you.
Hi, Mike. Thanks for having me on board.
No worries. Thanks for joining us. Now, can you tell us a little bit about what ESS is, I suppose, and how it works as well, just for those who might be unfamiliar with the phrase?
All right. So ESS, or employee share scheme, it's a way of remunerating your employees with some ownership in the business. So it's either you get some shares in the business or options to acquire shares in the business.
Okay, so I guess my next question is, what are the benefits for small and medium businesses who integrate ESS in their day-to-day?
All right. Look, a major benefit is you're sharing the vision with your employees and your business. So, you've got a long shot, you've got a long shot objective, and the employees are building value in your business, and they get a share in that. The share price triples, guess what? Their private wealth triples, and the original shareholders, their wealth triples as well.
Yeah, so it seems like a win-win-win. Let's talk a bit about how ESS can help grow small and medium businesses.
Right. So currently, the real hotshot at the moment is these startup concessions. So businesses that are under 10 years old, and they've got a revenue of under 10 million or 50 million if it's a group of companies, right?
Mm-hmm.
So the goal thing is, when you get your ESS, you get a discount. Normally, you get a discount. So instead of paying market value, you pay less or nothing, right? So ordinarily, you pay tax on this because it's part of your remuneration.
Yeah.
With the startup concessions, you don't pay tax on that. You don't put that discount in your tax return, which means that if you can't afford to hire the best talent in the market, what you can do is offer them some equity, and they're not paying tax on receiving that equity. They only pay tax when they sell their shares in the future, right? So what you're doing is you're competing in the marketplace for the best talent, and the people, the great thing is, Mike, the people who are signing up to this believe in your product, right? That's why they're coming on board and they're sticking around.
Exactly. No, it's an interesting one to sort of see who is interested and perhaps who might be just there for a gig. But how can ESS incentivize, I should say, both job candidates and existing employees as well? There's often a disconnect there. So can you break that down?
Well, look, if you're an existing employee, it's where does the business want to get to? How do I fit into that? And how can my personal wealth increase? This is the big thing here is I want a reward for helping you build your business, right? And the more engaged I am, the more I know what I'm going to get out of it. The increase in share value, the ability to get dividends, it's a win for new employees. It's a win for current employees. For the guys who want to come on board, when you understand what the future looks like for you. So 3 years, these schemes typically run in 3 to 5 years. So I know from day dot, if I hit my KPIs, the business hits their KPIs, this is what my personal income and my personal wealth looks like at the end of that period.
Yeah, Kudzai, what are some of the tax benefits of ESS for businesses and employees as well?
Look, the real tax benefit is for employees, and depending what particular scheme you implement or how you implement it. So we touched upon the startup concessions, right? So you don't pay tax on the discount. So that's a big one, and that's for startup companies, so under 10 years old, right? For companies that exist longer than that, that have been incorporated longer than that, there's what's called the tax deferral system. So deferral means you only actually pay tax on receiving those options or shares at a point where you can do what you want with those shares. You can sell them. So, how this normally works is I receive the right to buy shares in 3 years as long as the business hits a certain milestone. Let's say mixed revenue of $20 million, right? If the business doesn't hit that milestone, I don't need to pay tax, right? If without the deferral system, as soon as you get your shares, you're paying tax, or the rights to the shares, you're paying tax. So we
Yeah,
can defer we can defer that tax. That's the traditional big tax incentive. And then you've got the startup concessions. And again, if you qualify and your business qualifies, you can discount what you declare as assessable income in your tax return by $1,000.
it's an
Doesn't sound like
interesting
much, but
space.
it's
Kudzai, I'm just
still
aware of the time. We could unpack this a little bit further, but perhaps we'll get you back on the program down the track. But I want to thank you for bringing ESS to our attention and helping us understand it a lot more. So thanks again for your time.
right. Thanks, Mike.